Good afternoon and welcome to the SIA Wealth True Tactical presentation today. I am your host, Jeremy Fair, founder and CEO of SIA Wealth Management, Inc. This presentation is being recorded and a link to that recording will be provided from the SIA Wealth website shortly after the presentation ends today, as well as we will email it to all the people who have registered if you know somebody who hasn't been registered. I would ask you all to type any questions you may have during the webinar into the chat box, and we will respond to each person individually afterwards. Finally, there will be a survey at the end of the webinar on your interest in the SIA Wealth Tactical Portfolio Workshop, which was also included at the end of last month's webinar. With that, we'll get going on the presentation today. So our agenda is going to start with the SIA Wealth True Tactical Research and Development. We're just going to do a brief summary of some of the work that we're doing ongoing. Research and development is and continues to be a major part of what happens at SIA Wealth Management. We're going to look at True Tactical in action. Certainly the last year has highlighted much of the importance of True Tactical, and for those of you who have worked with SIA Wealth over the last 10 years, you've seen this in action many times, but the last 12 months are really highlighting what True Tactical can do for a client's portfolio. Thirdly, we're going to look at the SIA Wealth Management product review. We're going to take a look at two products, our global equity and our North American product. And then finally, we're going to go do some market insights. So I'll go through some of the charts that I think are relevant given today's market conditions. So the first area I wanted to touch on was technology development and our research and development. We are now in an evolving world, and with that, we're going to need evolving technology. What we've seen since 2008 is tremendous intervention by global central banks, global governments with deficit spending, and this is impacting how the free markets are operating today. There's also external factors that are having greater influence on the markets: globalization, geopolitical, economic, climate change, social causes, and demographics. These are having tremendous impact on the markets and creating more variables that need to be looked at by investment professionals. What we've done at SIA Wealth Management, as many of you know, is worked and partnered very closely with SIACharts. And that relationship has yielded us many strategies that are now listed with BMO Global Asset Management. But what we've done over the last few years is that we've started doing our own research and development. Like many of you, we're clients of SIACharts, and we're leveraging that relationship to get research and development on an ongoing basis. So this is something now that is constantly evolving, constant testing. A lot of members of our team and more time and energy and resources are being poured into research and development to take control of some of those different variables that are coming into the markets and the volatility that is there. We've done advancements in our algorithms and utilizing technology, and we're doing this at both the macro level and the micro level. So you're going to see more and more of that coming into play as we work moving forward. So one of the major enhancements that I wanted to talk about was something that we were working on prior to the correction in 2020. We hadn't yet implemented it, but we got it implemented into our product lineup at BMO Global Asset Management in July of 2020. And what that is to improve our transition zones. As many of you may be aware, we've always had our green, yellow, and red zones. What we've done since July 2020 in all of our mandates is blended the transition between green and yellow and from yellow and red in each direction. This allows us to move into cash or use more defensive strategies even while in the green zone as we see transitions. We can also, as it moves from the yellow zone into the red zone, we can hold more and more defensive positions even in advance of the red zone. And these are activities that you will have seen if you've been following our changes in all of our mandates over the last 12 months. It also works the other way. So as we come out of the correction, I mean, we are certainly in a corrective phase right now, which probably is not over. We will be able to be more proactive in the red to the yellow and from the yellow to green. So this works in both directions. And this all stands on the backs of our research and development that is proprietary to SIA Wealth Management. So how does that look in process? We continue to have our equity action call at the very top where we're bullish towards equities or bearish towards equities with a blending of the green and the yellow and a blending of the yellow and red zone. So we can be a little bit more proactive than what we have been traditionally up until July of 2020. And on the vertical horizon here, you can see that we're looking at all the different asset classes in real time and on a shorter term basis. This is where we can gain intelligence onto what is happening and can allow us to be more proactive, as we'll show further in this presentation. Next, we'll take a look at True Tactical in action. I think the last 12 months really highlight some dramatic changes for investors in the SIA Wealth Management product lineup, especially our equity lineup. So what we started to see, and this is just for display purposes, this is not the data that we use when we're making investment decisions or asset allocation changes within the portfolios. But what we did notice is that the breadth in the market started to dramatically diminish in May 2021. So that had started at the early part of 2021, but by the time we got into May 20th, we had seen enough that we started to see risk was getting much, much higher in the marketplace. And this chart here really highlights that divergence of the breadth. The darker line is the S&P 100 OEX, so the 100 largest representatives within the S&P framework. And the lighter line is the Russell 2000, which is a broader measure of mid-cap and smaller cap equities within the United States. So that divergence is one of the things we do. We do look on an equal weight basis. So this chart here just highlights extremely well what the culmination of that was. We saw in advance of the change into the yellow zone, which did not happen until February 2022. We can see on the line here where on the equity action call where April 2020, we moved into the green. But if you go to that May of 2021 timeframe, we were in the green zone and we were able to see that. Where we sit today, though, is a very, very different matter. We're in the yellow zone, and since this chart was created, we've also moved down a notch closer to that red zone. What we see in the rankings now is commodities at the top. It's been there for a period of time. U.S. equities, but international has now moved down to the 6th position, and cash, Canadian equities in the 5th, and bonds in the last place. So we've got a very, very different market, a different environment than what we've previously seen. So how did that look? How did we execute within our mandates? What you're looking at here is the BMO Tactical Global Equity ETF Fund, Series F. You can see the green zone. This is that fund's performance line over the last, since the start of 2022. While we were in that green zone, we had moved into cash before we got to the yellow zone. Up to 41% is where we were once we got into the yellow zone. And you can see that dramatic divergence as we got more defensive, even while in the green zone. That helped us in anticipation of what happened in the yellow zone. The spread now, we've got a cash equivalent of 62% in the portfolio right now, with financials representing 13% and energy representing 12%. We also should highlight that since the beginning of the year, we did not have positions in IT, so that technology side is away. But there's a dramatic divergence. This is up until the end of April of 2022, with the BMO Tactical Global Equity performing minus 2.54, with the benchmark sitting at minus 11.39. That spread has expanded dramatically, which is sitting just under 9%, and that has now moved into a situation where there is, on a year-to-date basis, a 12.84% divergence between our performance in this product and its benchmark. Looking at the BMO Tactical Global Asset Allocation Fund, again, we can see the green zone, but we were getting more defensive in advance of that, starting in May of 2021. Once we moved into the yellow zone, we were sitting at 65% fixed income or cash equivalents, and we currently now sit at 77% fixed income and cash equivalents, with a small position in financials, a small position in energy. The divergence between the two between our product and the benchmark on a year-to-date basis is a little bit over 5. That has now grown to over 7.45% divergence and outperformance between the Tactical Global Asset Allocation Fund and its benchmark. Looking at our BMO SIA Focused North American Equity, a very, very similar position. We can see even a more pronounced interference and outperformance by our cash positions while we were in the green zone on this. Certainly more volatility happening in a individual security, a focused portfolio. When we entered the yellow zone, we were 35% cash, financials 20%, energy 20%, no positions in IT. We're currently sitting, at the end of April 29th, was a position of 60% in cash, 20% energy, 6% financials, materials, and healthcare. And again, no positions in IT. Positive 1.28 to the end of April with our benchmark at 7.43. If we look at that today on a year-to-date basis, we've got a 12.85% lead on our benchmark on a year-to-date basis. The final one I think we're going to look at here is the BMO SIA Focus Canadian Equity Fund, Series F. Again, you can see the green move into the yellow where we were sitting at 41% cash, financials 20%, energy 20%, no positions in IT. If we go to the end of April, we were sitting with a cash equivalent of 74%, energy with 20%, materials 6%. And although we don't have as big of a benchmark increase here, we did this with a lot of cash, and largely the energy positions and the material positions were keeping us above that benchmark through 2022. And just like the other products sitting today, we now have a 7.66% year-to-date lead on this mandate. So what's happened since the end of April and where we sit today on May 19th has been quite impressive. Here's a timeline of our cash allocation for the BMO Tactical Global Equity ETF Fund, just to show in real terms what those transition periods look like from green to yellow when we were seeing that. If we go back to July of 2020, we were sitting with 0% cash. As we moved into May of 21, when we started to see those major divergences in the breadth of the market and started to see risk increasing, we took on a small cash position of 15%. By October of 2021, we had moved to a 26% cash position. And again, here you see the indexes still going up. The iShares MSCI World is still going up. So again, we're seeing these indicators because we use equal weight indexes in advance of the cap weight, but that allows us to be a little bit more predictive with the market. By the time we got to February of 2022, we had a 41% cash position, and the decline had already started, and we moved into the yellow zone. And then by April of 2022, we had a 62% cash position. So this is just a great timeline of how we're getting defensive and how we're being proactive with our true tactical solution. So here's our true tactical funds, the ones that have equity positions in them. We've got the BMO Tactical Global Equity Fund. As of April 30th, 62% cash equivalents. The BMO Tactical Global Asset Allocation Fund, cash equivalents and fixed income at 77%. The BMO SIA Focus Canadian Equity Fund, ZFC, is the ETF equivalent. It's got 74% cash equivalents. And then finally, the BMO SIA Focus North American Equity Fund, ZFN, in its ETF form 60% cash up until April 30th, 2022. So now we'll take a look at a couple of our products. We're first going to look at the BMO Tactical Global Equity ETF Fund update, and we're going to show you some highlights on what we found on the relative benefits versus Morningstar's fund category. So first, we've got low risk over 3 years while providing an above average returns. The next slide will show that. We've got stronger risk-adjusted rates of return, so higher than the average Sharpe ratio, positive alpha, and lower beta relative to the Calgary. We've got improved downside capture relative to the category while generating a positive total return capture ratio. And then looking at the highlights here, we can see in yellow, we can see our percentile ranks. The 5-year now puts us in the top 15%. And from 1 year right up to the 1 day, largely we're in the top decile or top 2%, with the exclusion of our 1 week, which is at 63%. So tremendous difference in outcome. What we're seeing here, where the investment on the 5 year is now at 7.84, and our category and our group is at 5.34. So even though we may not have looked as good over the last couple of years, this true tactical methodology certainly proves its merits when we get into rougher markets, as we've seen for the last year. The next page is just this comparative performance versus peers. Again, we can see on the left the risk is below average and the return versus category is above average. Our alpha is 1.29 versus a category of negative 1.53 and the index at 0.14. Our beta is 0.73 versus our category at 0.98 and the index at 1.01. When we look at the market volatility measures in the bottom right corner, our upside is 81% capture versus the category of 91. And the downside is 75% versus a category of 101. So again, we may not be capturing as much upside potential, but that divergence that we get on the downside has dramatically improved how this product works in that true tactical form. The second product we're going to look at is the BMO SIA Focused North American Equity Fund. And again, very similar to what we saw in our global equity product, we've got low risk level. This is over 3 years versus the other product at 5 years. This is just because this product has not been around as long, started in 2019, but it has a low risk level over 3 years while still providing average return relative to the category. We've got stronger risk adjusted rates of return, higher than average Sharpe, positive alpha, lower beta relative to the category. And again, improved downside capture relative to the category while generating a positive total return capture ratio. So if we look at the bottom on our 3 year, we're in the top 14% percentile from the 1 year forward, very similar to what we saw in our global equity mandate. We're either 2%, 1% with just the very short term differences that are there. And then finally, on the final page here, we can see the below average risk versus category in the top left, average return for this product. But if we look to the right a little bit on the top right, we'll see our alpha at 2.8 versus the category at minus 3.07. We can also see beta at 0.52 versus the category at 0.92. And then in the bottom right, we can see our upside capture is 55%. With our downside capture at 40% versus the category at 80% of upside and 94% of downside. So again, pretty strong numbers and a pretty strong highlight of what that true tactical methodology brings to your investment portfolio. The last area I'm going to speak on today is just our market insights. This is something that obviously I think everyone on this call is going to find very pertinent. We'll go through some important charts as we move forward on this and some highlighting some of the key areas that we need to watch for as we move forward in this very volatile market. So I love this quote. This is something that Ted Bader said to me a number of months ago. You know, what is your game plan? I think this quote from Mike Tyson is very incredible. Everyone has a plan until they get punched in the face. So a big reason why True Tactical and SIA Wealth Management is here is that we have plans, we have objective plans, and when things get tough, we generally show our strengths very, very well. So the first page that I want to highlight is what we call the double bubble. And what I've added to this is the diminishing influence. So the double bubble speaks to the debt bubble and the stock market bubble that we've been faced with. Really started post 2008, but came to full light in the post 2020 COVID response from central banks and government. So the debt bubble, we've got central banks, corporations, consumers, heavy debt. We've got huge mortgage debt through housing that are on there, and housing prices that have extended, especially in Canada, to levels that you know, really have not been captured from most of the long-term analysts that I've been speaking to or listening to on the web. We've also got a stock market bubble. Market valuations are at extremely high levels relative to history, as well as we've had a tremendous run-up in big tech. I think we all are very cognizant of what's happened in both of these areas. But what's ruining the party is inflation. We've got massive food prices increases, energy price increases, which are hurting consumers, but it comes across the board. There's really no place, I think, that any of us could find in our lives where anything is getting cheaper. And these increases are now into the double digits in many cases on staples and important things that we need to deal with. And what's really important is that inflation has changed how central banks and governments can deal with it. We've got rising rates from central banks, and we've got reduced spending capabilities by governments, or they're going to spike inflation further and create problems that might be significantly harder down the road to fix. The double bubble bear market facts, I think, are extremely important. We are not sitting in isolation from history in the predicament that we find ourselves in with debt and stock market bubbles. The first one that we wanted to highlight here during an inflationary bear market declines is January 31st, 1966, which lasted all the way up to October 31st, 1982. The Dow total return over that time frame was 0.81%. Inflation increased at up to 307.72%. So the Dow inflation adjusted rate of return over that time frame was negative 67.24%. So that's a massive depreciation on what the real value of our portfolios would have been had we lived during those timeframes and been index investing, which, as we all know, many investors have really run to over the last decade or so. So that time frame was 16 years and 9 months. The second one, which many on this call were a part of, myself included, was from January 31st, 2000 up until September 30th, 2011. The Dow actual rate of return was negative 5.08%. Inflation was at 134.41. So the Dow inflation adjusted return was negative 25.79. So that was 11 years and 9 months. Certainly, these two markets, if that's what we're looking at going forward, create some problems that have not been faced for some time for investors, and more importantly, investment advisors, ourselves included at SIA Wealth Management. So let's take a look at where we are as far as the rankings, and I apologize I didn't have an updated asset class diagram on the first chart that we saw that, but on the equity action call, we can see post March 2020, where we had the dip into the red zone, moved into the green, that we've slowly been declining. So if you look back at the last almost inverted rectangle in the equity action call, that was pretty much where we started to see that divergence in all of our new metrics that we use with the equity action call, and started to get more defensive in the marketplace in May 2021. But where we see ourselves now is a further decline just above the red zone. We have not moved into the red zone. One of the questions that we fielded over the past number of months is whether or not the poor performance of bonds has hurt the equity action call, or slowed the equity action call rather, from reaching the red zone sooner. And that is good analysis. We've seen, and I think that shows in that work that we've done over the past year as we moved into equities, it really narrowed down where investors were looking for opportunities in equities, and continue to look for opportunities in certain sectors as much as possible, because bonds have yielded very, very poorly, and in reality have performed just as poorly as equities over the last year for the most part. But where we see ourselves now is commodities at the top. This has been a great place for investors to find strength. Certainly gasoline, energy, some of the food products are the leaders that are up in that space, and continue to be so. So I don't expect personally to see much of a change at that commodity level in the near term, even with the equity sell-offs, and we've seen some sell-offs where equities have dropped and commodities have dropped at the same time. They seem to bounce back pretty good. U.S. equity remains in the second position. It's being held up there primarily with a few sectors. We're looking at energy, consumer staples, utilities, to name a few. Materials have held up very well, but also it has the benefit of what we see during weak equity markets and trouble globally, is that the US dollar tends to rally more positively. So that hasn't been as pronounced as we've seen in other corrections, but it certainly has had a traumatic influence, which has held U.S. equity above cash at this time, which is in third place. Currency, which is just short-term fixed income, same as cash, but in currencies outside the U.S. and Canada, has also remained stronger as more defensive positions are being taken in short-term fixed income products. Canadian equity is now in fifth place, which will contradict what we see in the chart on the S&P TSX Composite. We've been rewarded on that, but we'll talk a little bit about that in a few moments. And international equity in sixth place. And then finally, bonds, which in traditional downturns should be, in the third position or even the second position, which have performed so very, very poorly continue to be in 7th spot. There has been signals that maybe that's going to change. Those have been short term and not for too long of a time frame, so we're watching that. Certainly one of the problems with fixed income is that the central banks are selling off of their balance sheet fixed income products, which is probably going to add to the continued pressure on fixed income. So the first chart I wanted to highlight today is the S&P 500 index, an extremely good chart, remains a good chart historically and today on seeing what's happening in a broad base within the United States. What we can see is from the bottom of this chart, which was in March of 2009, so at the bottom of the 2008 crisis, we've moved up 6 times, 6-fold in the past 13 years, so tremendous movement. This has come on the back of what I would represent as the strongest quantitative easing and government deficit spending that we've seen certainly in my lifetime, and any of the historical data that we have show us that this has been largely unprecedented. Since January, the S&P has moved through 2 support levels to the negative. This is the first time since 2020, so I don't think this is coming as new news to anyone on the call today, but we're seeing our first couple of negative signals since the crisis of COVID started back in 2020. The next major level of support is at 3,600, so that's key support for us to watch in the near term as we see it moving forward, which is about 5 boxes from where we are now, so roughly a 10% decline from our current levels. Would not be outside of the norm, considering we just had prior support taken out at that 39.74 level. But the main line that I wanted to highlight on this chart is that the retracement to the uptrend line. So as you can see, that 45-degree angle line that's at the low end of this chart is what we call our uptrend line, and generally we see that as a mean where investments, whether they're indexes, currencies, individual securities, commodities, generally will not extend themselves too far away from that mean without having a correction. So a 50% retracement would bring us back to the 2,800 level. So significant risk remains here, but we're not all bearish completely yet, even though in my view, government and central banks' abilities are being tested. They don't have the same tools that they might have had a few years ago. They certainly have access to data, real-time data they didn't have a decade ago in 2008 or 13 years ago or so in 2008, but they've got some serious problems here. So we'll see. But the first sign of strength would be a close above 4,302. The S&P TSX Composite chart looks significantly better than the S&P. So I get a lot of questions on this, especially given the rankings where you see U.S. equities sitting much higher in our asset class rankings than where we see Canadian equities. The broad Canadian equity index has performed well since the decline, but this outperformance comes on the back of very few sectors. So most notably is energy, which has moved up 54.13%, materials up nearly 6%, utilities up just over 4%, and base metals over 3.61%. But why we're seeing Canadian equities rank so poorly within our asset class rankings is that most other sectors are performing very poorly. So I wouldn't represent this as the same thing we saw back in the Nortel days where one investment was carrying the full weight, but it's certainly a lot narrower than what we've seen and comes on the back largely of commodities. So any commodity weakness, if we see a decline in economic activity and that finally reaches those inflationary commodity levels and starts to retrace them, that might come rapid, and we might see the S&P TSX Composite Index be penalized tremendously for that. Key support is above 18,121, so we have to watch that level, which is a ways below from where we're at. So again, probably a little bit around 10%. And then to the upside, we would really need to be looking at new highs at that 22,000 level or a little bit higher on that. So we'll continue to watch this chart for those. The other chart that I wanted to highlight, which really just represents what we've been seeing in the fixed income, the bond market is U.S. equities versus U.S. bonds. So unlike traditional situations in this comparison chart, if we see the chart moving up, this is when equities are outperforming bonds. If we see it moving down, well, that's when bonds are outperforming equities. But what we've seen is a consolidation. So really since the beginning of 2022, it's moved sideways. So fixed income has been punished very, very similarly to what U.S. equities have done. The S&P 500 is what we've got here. So this is left investors really with very few options for defense, which makes our true tactical portfolios even more important in markets like this, because we do have those options on our mandate. The commodity stocks have been a place to hide recently, but as I mentioned earlier on the last slide, is that the risk with commodities is that at some point they may roll over if we see true economic activity continue to decline as we've seen over the last quarter. And short-term fixed income and currencies may be the only place if we're going to see deeper declines in the realms of what we saw in 2008, or even that quick correction that we saw in 2020. So being flexible, being maneuverable, having those transition zones has become extremely more important within the true tactical mandates that we highlighted earlier. Crude oil, I wanted to show you this chart because crude continues to hold up. So even with the pressures that are happening on the economy, those inflationary areas in crude oil and food continue to keep going. So that transitory inflation that has been spoken about, I don't think anyone believes that that was the case. This is real inflation, but it continues to be there, even though we've seen these declines in the stock market, which are in my opinion, forecasting economic growth over the period of time. That still has not hit crude oil. I mean, it has performed very strongly over these equity declines. It remains strong even with the political influence. We've certainly heard over the last year tremendous efforts coming out of the United States government to reduce energy costs and gasoline costs, out of Europe to do the same. They've done things like dip into their strategic reserves. They've called upon countries where there may or may not have been strong trade agreements in place to increase their production and get that. But even with all those efforts, that has done very little to knock crude back. So it's quite telling how inflationary we are there. We remain invested in energy sensitive equities. So if you look at our mandates, as I walk through them, our equity mandates do have energy positions in them. It's been an extremely strong sector. And even though we don't have tremendous levels of investment into them, the small amount we've had and the outperformance that those have provided have given us alpha, even with our large cash position. So if we see continued strength here, though, we would expect this to put more pressure on Main Street businesses. So we're watching on the downside. That 92 level is a very, very important support level. That might be an indication that we're seeing the economy rolling over and the demand for crude dropping dramatically. I'm not sure where on the supply side that's going to have much of a difference. It's probably the demand side. But realistically, if I was looking at this chart in isolation, I would have a projected target in that 148 range for crude oil, which would mark its highs back in 2008. So crude technically remains very, very strong. This chart here is the US dollar versus Canadian dollar. There's been an interesting tug of war between USD and CAD since May of 2021. So on one hand, we've seen the breadth in the equity market start to decline. So more cash moving into safe havens, such as the US dollar, moving away from equities or other investments that are seen as more risk. Crypto is probably a big part of that as well. So we've seen money move to the US dollar for that. But at the same time, we've seen tremendous growth in crude prices, which, the Canadian dollar is still has big influence by the price of energy and then moved up. But the net result has been that from that 120 range up until about 129, the US dollar has moved over that time frame. So the flight to security, the flight to safety has been greater than the demand for Canadian dollars, and the US dollar has gone there. At the top end of this, we can see a 136 mark. So looking at this chart, that would be my projections, that we would see that 136 mark. Certainly, if equity weakness continues to happen here, we may see that. But again, it's that tug of war between crude and the weakness in the equity market. So we'll see how that plays out over the next few months. I think this might be my last chart here, and I think it's a very important chart because even though we've seen a lot of pain in 2022, we've seen that decline. This is the S&P 500, and at the top right, you'll see the one which is indicating January 1st of 2022. I got that black box up there to show you the range that we're in, and then I laid that over the 2008. So roughly looking at the pain that we've suffered in 2022 would be about 1/4 of the total pain that was seen in 2008. So as much as I've been hearing people communicating that maybe the worst of this is over if we're really into a decline, we've got this inflation, we've got these headwinds because of that, we've got less impact by central banks and governments, we've got consumers and underemployment. There's so many problems that are sitting here geopolitically with war in Ukraine. The risk remains extremely high. But that just should give you a clear highlight of whether or not, it is too late to make changes in your portfolio. I would suggest no, it's still early in the game with the amount of risk that's out here. We're going to have to be watching much closer to economic data. We certainly are watching more around here. It's having much more influence than that it has with all the money flows that we're moving in prior to this. So risk remain elevated in all of our indicators at SIA Wealth Management. And what that means, from my opinion, technically, is that to sell into the rallies. There doesn't appear to be anything technically or fundamentally that we can see that would dictate us hitting into new highs. So selling into those bear market rallies is probably where we would be advising our clients at this time. The final chart here, I want to talk about this, and this comes from a comment that was said to me from one of our partners, our major partners at BMO Global Asset Management back in 2020, when people were measuring the success of SIA's strategy, SIA Wealth strategies during that downturn. And he said, that the difference between you guys and the rest of the managers is skill versus luck. We were navigating that. The luck comes in because central banks and governments bailed out that market at that time, in my opinion. So what we've seen, and I think what is important for everyone on this call to recognize and to relate to their clients, is that some things are materially changing as we go forward. Central banks and governments have run out of their influence. They have had tremendous influence since 2008. We saw that in 2011 with additional quantitative easing. In 2016, we saw the Federal Reserve take policies that weakened the US dollar very, very dramatically, plus quantitative easing. 2018, more quantitative easing, and then 2020 was the mother of all influence put into one basket. We've been seeing this now for 13 years, going on 14 years. We've seen this influence within the marketplace, which is, in my opinion, largely unprecedented. But what has happened now since May of 2021 is that those measures have run into the wall. Inflation is everywhere. They don't have the same abilities, the same wherewithal to do what they want. So I think it's very, very important for all of us to understand that the way that we've earned returns over the last 13 years are likely and quite possibly going to change for the next 10, 13, or 15 years moving forward, as we saw with those inflationary bear market timeframes earlier. And my personal belief in this is that where advisors will be measured, ourselves included, are going to be how we navigate bear markets more than bull markets. Our clients have swung heavily into their own personal accounts or into indexing. So that indexing, those low cost ways of investing, it's hard in a bull market to necessarily compete with those, and that's not where our clients are going to measure. What they're going to notice, in my opinion, is that as this bear market moves on, and what it's done already to date, is that they're getting hurt, and they want solutions for that. So I think there's a strong opportunity for all of us to provide services and provide strategies that can have tremendous impact on bear markets. And we see that on the right here. I'll get that to a minute. And then I would just comment that, SIA Wealth provides a unique, true tactical investment solution. We have ongoing technology development. I don't know of any other company within Canada that's doing that, and we have it at all levels through the advisor spectrum. And we have a strong team of people that are true tactical solution experts. So, you know, we've been doing this now 20 years. We've gone through many market cycles. We've been developing software. We've been working one-on-one. We work with groups. We work with firms. I don't think there's too many firms on the street that are on the wealth management side of it that have the resources that we have that are there. And then on the right-hand side, this picture is a highlight of a portion of our tactical portfolio workshop at SIA Wealth. And what it is that we're positioning our SIA Wealth Management True Tactical, our equity and balanced solutions into this as a static. I think one of the mistakes that many of our clients have made over the last 6-7 years when we partnered with BMO is that they've been trying to time when SIA would come to form and when we'd be good, and that's a very, very difficult thing to do. I would suggest that that's on our role, and that's something that we do very well with constant innovation and getting those timings just right. So here's our fund codes and sales information. So hopefully we can look forward to your support, and we will support you on the backside of that. So by any means necessary, by phone, by email, by web, get a hold of us. Let's work together. We are looking for bigger and greater partnerships with our clients, and we certainly look forward to working with you in the future. So with that, that's the end of our SIA Wealth True Tactical presentation. As I mentioned earlier, if you've typed any questions into the chat box, those questions will be answered on a one-by-one basis. And this presentation has been recorded. We will email it out to each and every one of you. If you've registered and participated in this webinar, you will receive that, and it will be on our website if you want to point anyone else in that direction. With that, I thank you and bid you a good afternoon and look forward to speaking to you all in the future.